Subscribe to LearnCab and hit the bell icon to get notified.
Hi guys, welcome back to Companies Act. Let's proceed with a new concept today, corporate veil. Now we've already learnt about features of a company, and one of the most important features we learnt was separate legal entity. Now what did this concept say? This concept said company is different from its members. We learnt a company has an identity which is distinct from the identity of its members. Because a company has separate legal entity, it can enter into contracts in its own name. It can sue third parties in its own name. Even third parties can sue the company in its own name. Alright, now we will first learn a case law on Salomon versus Salomon and Company Limited. Now this case law is based on this concept of separate legal entity. Now what happened over here was this company Salomon and Company Limited was incorporated by Salomon. Alright. Now Salomon incorporated this company Salomon and Company Limited, and this company had totally 7 shareholders. So Salomon held 20,000 shares of the company. His wife held 1 share. His 4 sons held 1 share each, and his daughter held 1 share. So if you notice, the entire shareholding of this company is nothing but Salomon and his family. Alright, now what happened later on was this company Salomon and Company Limited went into liquidation. Now when it went into liquidation, it was not doing very well. Its assets were only worth £6,000, but it had liabilities worth £17,000. So it had to pay outsiders to the extent of £17,000, but it had receivables only to the extent of £6,000. And this liability of £17,000 was basically into 2 categories, alright. One was secured loan and the other was unsecured loan. Now the secured loan was worth £10,000, and this was nothing but debentures which were subscribed by Salomon. Alright, so the 17,000 liabilities includes £10,000 worth secured loan, and the balance 7,000 were unsecured creditors. So these 3 creditors, they owed to them the company owed £7,000. So total liabilities £17,000, out of which 10,000 was secured pounds in the form of debentures held by Salomon himself, and the balance 7,000 was due to outsiders. Now how much asset does the company have? Only 6,000. How much does it have to pay creditors? Totally 17,000, out of which 10,000 is secured, 7,000 is unsecured. Now what the company did was, the company sold away its assets, got 6,000 rupees cash, and it gave this cash towards secured loan. Now who owns the who has given the secured loan to the company? Salomon. Salomon has subscribed debentures of the company. Those debentures are sitting in the form of £10,000 of secured loan. So what the company did was, company paid the 6,000 to Salomon as setting off towards the secured loan, as payment towards the secured loan of £10,000. When this happened, the creditors got angry. They were like, Salomon and Company Limited, you all are one and the same. Salomon and his family only owns the company. So the creditors said that company, when you sell away the assets, when you get £6,000, first pay us. Only then if you have any surplus, you pay Salomon. But pay the outsiders first, only then you can pay Salomon, because Salomon is your own person. Salomon and the company are one and the same. This is what the creditors said. What do you think? Are the creditors right? Are Salomon and Salomon Company Limited actually one and the same? No. You know very well that there is a separate legal entity concept, because of which shareholder and the company are not one and the same persons. They are considered as 2 distinct persons with different rights and liabilities, right? So the creditors were wrong in asking the company to pay them first. Now see, every time whenever we have liabilities, whenever we have secured and unsecured liabilities, obviously whom do we pay first? We obviously pay the secured loans first, isn't it? The fact that the person who had given the secured loan is none other than Salomon, that has absolutely no relevance to the discussion. The fact that the biggest shareholder, the fact that the main shareholder only is a secured creditor also makes absolutely no relevance, because the creditor, the shareholder and the company, they are all 3 different persons in the eyes of law. Alright, so the creditors told that Salomon cannot be treated as sundry creditor. It is a one-man company, no different from Salomon. Creditors were saying Salomon and Company Limited, Salomon, you all are one and the same. The court held that no, company is different from its members. The separate legal entity concept, and this concept says very clearly members are different, company is different. So it is not wrong that the company has paid the secured creditor Salomon first. Alright, so because now the company paid entire 6,000 towards Salomon secured loan. Now there was nothing else left, and hence the unsecured creditors went unpaid. Absolutely nothing wrong. The company has not done anything wrong over here by paying off Salomon's secured loan first. Alright, okay. Now, so this concept tells us so even this case law tells us very clearly separate legal entity concept exists, because of which company is different and shareholders are different. They see this difference between company and shareholder as a veil. They say there's a veil, there's a curtain between the company and the shareholder, and this curtain distinguishes both. This curtain gives both of them different identities. A company can purchase assets in its own name. A company can hold assets in its own name, whether movable, immovable, whether tangible, intangible, doesn't matter. A company can own assets, it can acquire assets, it can dispose assets all in its own name. It can also enter into liabilities in its own name. Alright, so company is different from its members, and which concept is this? Separate legal entity concept. This says there is a veil or a curtain between company and shareholders. So company has its own existence, a separate legal entity. Members are not liable for the company's acts. For whatever company does, who will be liable? Company alone will be liable. For whatever the company does, I can't hold the shareholders liable, and similarly for whatever the shareholders do, the company cannot be held liable. Veil of corporate personality. There is a veil which gives the company a personality of its own. Now, can this veil be lifted? Can we erase this veil? When we erase this veil, what will happen? Company and the shareholders will be treated as if they are one and the same. So there is a veil between the company and the shareholders. Can I remove this veil? Can I lift this veil? Yes, in extraordinary circumstances, this veil can be removed. In extraordinary circumstances, I can lift the veil and treat the company and the shareholders as the same person. What are these extraordinary circumstances? We'll be learning in the subsequent playlist, in subsequent slides as case laws. But do remember that in extraordinary circumstances, this veil can be lifted and the company and the shareholders will be treated as one and the same person. See, if they're one and the same person, then company will be liable for shareholders' acts, shareholder will be liable for company's acts. They're the same person. Alright, once veil is lifted, members will also be personally liable. Members, shareholders will also be liable for obligations of the company. So generally there is a veil between company and shareholder. This veil gives them two different identities. But in extraordinary circumstances that we will be learning a little later, in these extraordinary circumstances the veil can be lifted. Once I lift the veil, remember, company and shareholder will be treated as one single person, and when that happens, my shareholder and the company will be liable for each other's acts. Shareholder will be personally liable for the company's acts. Shall we see these extraordinary circumstances one by one? Alright, come on. The first situation, the first circumstance in which I lift the corporate veil is to protect the public policy. Let me give you an example over here. There were two companies, A Limited, which was incorporated in England, and B Limited, which was incorporated in Germany. Alright. Now, A Limited's entire shareholding was held by B Limited. So basically I can say B Limited is the holding company of A Limited. A Limited is a subsidiary company of B Limited. Alright. So B Limited held all the shares of A Company Limited. So I can say that the entire shareholding, what's the shareholding of A Company Limited? B Company, isn't it? B Company is a German entity. So I can say that the entire shareholding of A Limited is held by Germans, isn't it? And also A Limited's directors and B Limited's directors both were German residents. So A Limited was controlled by German shareholders and A Limited was managed by German directors. So its directors and its shareholding both were Germans, but it was incorporated in England. Understood the story? So this A Limited was incorporated in England, but it is controlled by German shareholder B Limited, and it is managed by German directors. Now, why was this company formed? This company was formed because B Limited used to manufacture tires. Alright, so B Limited was in the business of manufacturing tires. They wanted to sell these tires in England. So they formed a company A Limited in England to sell tires made by the German company. Alright. Later what happened was the First World War began, and when the First World War began, England and Germany were on opposite sides. They were enemies. Alright. Now while the World War was going on, it was still going on. At that time, A Limited filed a case against Z Limited. Z Limited also was a company which was incorporated in England. Alright, so A Limited filed a case against Z Limited because Z Limited was not repaying some money which was due to A Limited. So A Limited filed a suit for recovery of debt against Z Limited. Now when this case went to the court, the judge held that A Limited is the alien enemy of the country. Now when the case went to the English court, I'm talking about the decision over here, when the case went to the English court, the judge said that A Limited becomes what? A Limited becomes an alien enemy. See, listen to me very carefully. Now, in our example, what is A Limited? A company. A company does not have a mind of its own, isn't it? So, a company technically cannot be an enemy or a friend because it doesn't have a mind of its own. But still, if it is controlled by enemies, or if it is managed by enemies, then I will call the company as an enemy. So if the company, because a company doesn't have a friend or doesn't have a mind of its own, a company cannot be a friend or an enemy. But I will still call the company an enemy company if it is controlled by enemies or if it is managed by enemies. Now over here, A Limited is controlled and managed by whom? By Germans. Now for England, Germany is an enemy, isn't it? So I can say A Limited is controlled by Germans, A Limited is controlled by enemies, and hence what does A Limited become? A Limited becomes an enemy company. A Limited becomes an alien enemy. And what happens to contracts with alien enemies? They become void, right? Why can't I enforce contracts with alien enemies? Because it is against public policy. So if a case is brought to the court by an enemy company, by an alien enemy, it will be against public policy. So to protect the public policy, to decide whether a company is an enemy or a friend, the court can lift the corporate veil. That's what the court did over here, isn't it? The court went beyond. The court saw who is owning the company. The court saw the company is owned by Germans. So what did the company do? See, actually, if you see between A Limited and the German shareholders, there must be a corporate veil. Because it's a corporate veil, A Limited different, Germans different, two different personalities. But to decide whether A Limited is an enemy company or not, what did the court do? The court lifted the corporate veil and saw who is controlling A Limited. Enemies were controlling A Limited, hence the company and the shareholder are treated as one and the same person. Because the shareholders are Germans, because it is controlled by Germans, enemies, automatically even A Limited becomes an enemy. So to protect the public policy, the court might lift the corporate veil. Once the court lifts the corporate veil, the company and the shareholder will be treated as one and the same person. Alright, let's read over here what's mentioned. The trading company is A Limited. A Limited, even though it is incorporated in England, it is opposed to public policy if the majority shareholding is in the hands of Germans. Germans were enemies at that time. Hence, veil lifted to ascertain whether company is an enemy company. Is a company an enemy or a friend? To decide that, you will lift the veil and you will say the company and the shareholders are one and the same. Understood? This was held in the case of Daimler Company Limited versus Continental Tire and Rubber Company Limited. Alright, so we've learnt about the first circumstance when the veil is lifted to protect public policy. Now let's look at the second situation when the veil is lifted to check avoidance of taxes. See, if the whole objective behind creating a company is to avoid taxes, to evade taxes, in that situation the company will lift the corporate veil and the company will treat the shareholder and the company as one and the same. Alright, so what's the whole objective over here? Why was a company created? The company was created to evade taxes. If that is the situation, the court will lift the veil and the court will treat the shareholder and the company as one and the same. Let's see what happened over here. Now, Red, a person, he held a lot of investments, alright. He held a lot of investments in the form of shares, let's say shares and debentures, a lot of securities he was holding. And because he was holding a lot of investments, he was receiving a lot of income in the form of dividend and interest. This income was so huge that he was getting from these investments that he had to pay huge tax. So he had no other income, no other asset. He had only investments in his hand, and these investments were fetching him a lot of dividend and a lot of interest income. Because of this huge income, he was having to pay a huge tax, and he did not like paying so much tax. So he was thinking, what do I do? Very smartly, what he did, he created 4 companies. All right, he created 4 companies and he transferred these investments that he was having to these 4 companies. Now tell me, who owns these 4 investments? These 4 companies will now own these investments. Alright, now very smartly he transferred these investments to these 4 companies in such a way that how much ever income these 4 companies get from these investments will be below income tax limits. See, always remember that income tax has exemption limits. Like for example, as of now, if your income is not more than 2,50,000, you don't have to pay any tax. So these are called exemption limits. Up to 2,50,000 of income, your assessee is exempt from income tax. He doesn't have to pay tax. There's a certain minimum amount of income. Up to that, you don't have to pay tax. Alright. Now keep this in mind and now listen to me. Now these companies are holding investments. So they are the owners of the investments. So who will earn interest income? Who will earn dividend income? These companies only will earn these income, isn't it? So what Red did was, Red transferred these investments to these companies in such a way that when they earn income from investment, the income will be earned in such an amount that it will be less than the minimum amount which is not subject to tax. So in our example, and in the present situation, let's say they will receive income in such a way that their income is less than 2,50,000. Up to 2,50,000, no income tax, isn't it? See, if all the income is earned by one person, then total income is more than 2,50,000, he has to pay tax. But what did he do over here? He distributed this income among these 4 companies in such a way that whatever interest income was being earned was less than these exemption limits. Hence, there was absolutely no tax liability. Alright, so all these investments were transferred to the 4 companies, or these 4 companies hold investments. Now, these 4 companies earned the dividend interest income, but in what manner? In such a manner that the amount of income that they received was less than the amount which was subject to tax. Hence, there was absolutely no tax liability. Now, tell me, what was the whole reason? Why did Red create these 4 companies? What was the objective? Red created these 4 companies because he wanted to distribute the income in such a manner that there's absolutely no tax liability, isn't it? So income within exempted limits, no tax was being paid. Now tell me, who has the investment? The 4 companies. Who has earned the income? The 4 companies. But who wants the income? Red wants the income, isn't it? So what the companies did was, the companies transferred this, the company lent this interest income to Red as if they are loans, and these loans were never repaid. Diverted in the form of pretended loans that were never returned. See, what will the company do with this money? The company has no business. The company has no other assets. The companies were formed only for the purpose of holding these investments, earning interest income so that tax is avoided. But who actually wants to enjoy this income? Red, isn't it? So for Red to enjoy this income, the companies were transferring this interest income to Red in the form of a loan. They were passing entries as if they are lending money to Red. But did Red, see, if the loans are genuine, the loans should have been repaid after a certain time, isn't it? The loans were never repaid. So that is why the court used the word pretended loans. They were pretending as if it is a loan, actually it was not a loan. So when this entire situation happened, when the court came to know about it, actually there is a veil. Actually shareholder is different, companies are different, treated as 2 different entities. But what was the whole reason? Why was the company created? The company was created to evade taxes. When the whole purpose behind creation of a company is to evade taxes, the veil will be lifted and the company and the shareholder will be treated as one and the same person. So if they're treated as one and the same person, then whether the companies earn the income or whether Red earns the income, it's the same, isn't it? So it was as if the entire income was earned by Red and Red was asked to pay tax. Alright, only purpose for incorporating the company was to evade taxes. Companies were just a sham. Income earned by all companies will be treated as if it is income earned by Red. Alright, so the veil was lifted and the companies and the shareholder were treated as one and the same person. So as if the entire income was earned by Red, he was asked to pay tax. This was held in the case of Sardin Shah Manekji case. So what's the second situation? When is a veil lifted? To check avoidance of taxes. Alright, so we've learnt about two situations: to protect public policy and then to check evasion of taxes. Now coming to the third situation, when the veil is lifted, to check avoidance of welfare legislations. Now we have a lot of employee welfare legislations in the country. For example, we have the Payment of Bonus Act, we have the Payment of Gratuity Act, then we have Employees Provident Fund and Miscellaneous Provisions Act. There are various employee welfare legislations in the country. Now let's talk about Payment of Bonus Act. Now this Payment of Bonus Act requires companies or requires entities, some specified entities, to pay bonus to its employees if their profit is more than a certain limit. So they have so basically how much bonus is paid to the employees depends upon how much profit the company has made. You understand? How much bonus how much bonus employees receive depends upon what? Depends upon how much profit the company has made, the entity has made. So what happened was, this one particular entity was having huge profits, and because they were having huge profits, they had to pay huge amounts as bonus. They did not want to pay so much bonus. So what this entity did was, this entity created a new company. It created a new company and it split its business with itself and this new company in such a way that, so now the profit also gets split, isn't it? So if A Company Limited was earlier earning 100 rupees profit, now this A company is splitting into A company and B company. So the business is being split between both of them. So even profit will be split between both. So which means, let's say 50-50. Let's say A was earning 50 rupees profit now, B was earning 50 rupees profit now. Now because profit became lesser, the bonus outflow also became lesser. So what was the whole objective? Why did A Limited create B Limited? The whole objective was to reduce the profit, so that when the profit reduces, automatically even bonus payments will be reduced. So when this happened, when the court realized that the whole objective behind creating B Limited was to avoid payment of bonus, to reduce the payment of bonus, to avoid a welfare legislation, even over here the court lifted the corporate veil. And the court said, I will treat as if A and B are one and the same, as if the entire profit is made by one company, A Limited. The court lifted the corporate veil and said A and B will be treated as one and the same, as if the entire profit is made by A Limited, and then so it's as if A Limited made the entire profit of 100 and A Limited will have to pay bonus on the basis of this profit. Do you understand? So if the objective of forming the company is to reduce gross profits so that bonus payable is reduced, then veil will be lifted, the corporate will be lifted, and bonus will be paid as if no new company is formed, as if B Limited is not formed, as if only one company, A Limited, as if the entire profit is earned by A Limited. This was held in the case of Associated Rubber Industries Limited case. Alright. So in the third situation, what has happened? What is the whole objective? Why are we creating a new company? We are creating a new company over here because we want to avoid a welfare legislation, an employee welfare legislation. For example, we want to avoid paying bonus. So even over here, the veil will be lifted and the shareholder and the company will be treated as one and the same person. Alright. So we've learned three situations. We've learned number one, to protect public policy, the veil will be lifted. Then to check avoidance of taxes, veil will be lifted. And then we learned to check avoidance of welfare legislations also, the veil will be lifted. Alright, now let's learn the fourth situation. This is something which is very important. Company was incorporated for a fraudulent purpose or to breach an existing contract. If the whole objective as to why the company was formed is to defraud another person, to fool another person, or to breach an existing contract, if the whole objective is to breach an existing contract, even then the veil will be lifted and the shareholder and the company will be treated as one and the same person. Let's look at an example over here, Guilford Motor Company case. What happened over here was, now Red was an employee of A Limited. So Red was an employee of A Limited, but Red wanted to leave A Limited. Now when Red left A Limited, at that time, Red and A Limited entered into a contract. Alright. Red promised A Limited that after I leave from your service, after I leave your workplace, I promise you that I will not take away your clients. I promise you your clients will remain your clients. I will not steal away your clients. I will not do business with your clients. So what is Red telling A Limited? I am leaving your company, but I promise not to solicit your customers. I will not do business with your customers, because if I start doing business with your customers, your profit will reduce, isn't it? So I promise I will not steal your customers. Alright. So Red had promises to A Limited. But now after making this promise, now Red is tempted. Red wants to enter into contracts with customers of A Limited. Now, can Red enter into contract with these people? Red, can he do it directly? No, isn't it? Because Red has already promised. What will happen if Red enters into contracts now with customers of A Limited? It will be a breach of this contract, isn't it? That is why Red is not allowed to enter into contract with these people, with customers of A Limited, but Red wants to do it. So what Red does is that Red creates a company B Limited. Alright, Red creates a company B Limited, and this B Limited enters into contracts with these people. And what will Red say? Red will say, I am different, company is different, separate legal entity concept. I am not dealing with your customers. Who is dealing with your customers? Only B Limited is dealing with your customers. So what is Red trying to do over here? What is Red's objective? Red wants to breach this contract. Red had earlier promised, I will not deal with your customers, but Red wants to deal with those customers. To be able to do that, to be able to deal with A Limited's customers, Red creates this company B Limited so that indirectly he can deal with the customers. So the whole objective behind creation of B Limited is to breach this contract, isn't it? Because now B Limited is entering into contract with these customers. So when the whole objective is to breach an existing contract, the court will lift the veil and the court will treat as if the shareholder and the company are one and the same person. It will be as if Red only has entered into a contract with these customers of A Limited, and hence it will be a breach of this contract. Alright, so when the whole objective behind creation of a company is to defraud a person, to fool a person, or to breach an existing contract, veil will be lifted. See, even over here, what was the whole objective? Why did Red create B Limited? Because indirectly, he did not want to follow this contract. He wanted to somehow be able to deal with A Limited's customers. That's why he created B Limited. So that is why the veil will be lifted. It will be treated as if Red and B Limited are one and the same. It will be treated as if Red is the person who has entered into a contract with A Limited's customers. Hence, it will amount to a breach of contract. Red will have to pay damages to A Limited. Alright, veil was lifted. Restraint orders were passed on B Limited. What do you mean by restraint orders? Restraint orders is nothing but a stop order. An injunction order was passed asking B Limited to stop dealing with customers of A Limited. Alright, so we've learnt about 4 situations. We've learnt to protect public policy, then we learnt to check avoidance of taxes, to check avoidance of welfare legislations, and now we learnt if the whole objective is fraudulent purpose or the whole reason why it is formed is to breach an existing contract, we will lift the corporate veil, treat the shareholder and the company as one and the same. Alright, now let's go to the fifth scenario. Fifth scenario when the veil is lifted. The last scenario, this is if the corporate status is used as an agency instrumentally. Let's see this case, FG Films Limited case. Now what happened over here was, this company A Limited was a British company. Alright, it was incorporated in England. And its entire shareholding, most of its shareholding, 90% was held by an American company. So American company becomes a holding company and A Limited, this British company, becomes what? The subsidiary company. Alright, now this A Limited subsidiary company was making a film in India, and that film was financed by the American company. So this British company is held entirely, most of its shares are held by the American company, and this British company is producing a film in India, and even that is financed by the American company. So the Board of Trade refused to register this film as a British film. They said that this American company has created a British company as if this is a principal and this is the agent. So the Board of Trade held that there's an principal-agency relationship over here. I will treat this film as if it is an American film, as if it is created by the American company only. Board of Trade refused to register the film as a British film. The English company, the Board of Trade said the British company is nothing but an agent of the American company, because see who is holding most of its shares? American company. Who is producing films also of this company? The American company only, isn't it? That is why the Board of Trade said that I will treat A Limited as agency of the American company, and hence I will treat them both as one and the same, and I will register the film only as an American film and not as a British film. So they've lifted the corporate veil. The corporate veil was lifted, and A Limited and the American company were treated as if they are one and the same person, as if they are one and the same person, and the film was registered only as an American film, even though A Limited was the one who made the film. Why was it done? Because the court said A Limited will be treated as an agent of B Limited, of the American company, because number one, entire shareholding held by American company, and also film produced by American company. So it's as if American company is the principal and this British company is the agent. Alright, okay, so we've learnt about 5 situations. First, we learnt to protect public policy, the veil will be lifted. Remember that example, Daimler Company Limited versus Continental Tire Company. So to protect public policy, to determine whether a company is an enemy or a friend, we will lift the corporate veil and we will see who is actually managing this company, who is actually controlling the company. If those people are enemies, and even the company will be treated as an enemy company. Then we learn to check avoidance of taxes. The Insha Manekji case, if the whole objective behind creation of a company was to avoid taxes, then the shareholder and the company will be treated as one and the same person, right? And then we learned Associated Rubber Industries Limited case. If the whole objective behind creation of a company is to avoid a welfare legislation, even then the veil will be lifted. Remember, we saw that a new company is created because we wanted to reduce profits, because if profits are reduced, automatically even bonus payments will reduce. So even over there, veil is lifted, shareholder, company as one and the same. Then we learnt of the whole objective is to breach a contract, Guilford Motor Company case, wherein the whole reason why the B Limited was created was because Red wanted to breach the contract with A Limited. Red wanted to deal with A Limited's customers. Even over here, the veil will be lifted. And lastly, we learned if corporate status is used as an agency, FG Films Limited case, even then the veil will be lifted. So in all of these situations, the company and the shareholder will be treated as if they are one and the same, and the shareholder will be personally liable for the activities of the company, as if the shareholder only has done those actions. Alright, so this is it with this playlist. In the subsequent playlists, we will learn about categories of companies. Thank you.
Subscribe to LearnCab and hit the bell icon to get notified.